Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Conant Optical Co. Limited Annual Report. Shanghai Conant Optical Co. Limited offers a wide range of businesses and services that cater to various needs of customers worldwide. The company's primary business involves the manufacture and sale of resin spectacle lenses, which are available in standardized and customized forms. The company provides a variety of lens types, including UV++ series, 1.74 series, single vision, student, progressive, high-vex, business, specialty, and anti-fog lenses. Additionally, they offer specialized products such as UV shield glasses and gaming glasses. These diverse offerings enable the company to cater to different customer segments. In terms of services, Shanghai Conant Optical Co. Limited provides after-sales support, which is essential for maintaining customer satisfaction and loyalty. The company's extensive global reach allows it to serve customers in mainland China, the Americas, Asia, Europe, Oceania, and Africa. Overall, Shanghai Conant Optical Co. Limited's business scope encompasses the manufacture and sale of various spectacle lenses, as well as after-sales support services, making it a comprehensive provider in the optical industry. Shanghai Conant Optical Co. Limited market capitalization of $24 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Shanghai Conant Optical Co. Limited holds a significant advantage in their industry. Shanghai Conant Optical Co. Limited trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 7.85 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 34% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given data. On the positive side, the company's revenue grew by 6.1% from RMB 125,203 in 2024 to 2025, driven by various factors. The increase in gross profit by 15.4%, total sales volume by 3.9%, and mainland China sales by 14.3% were significant contributors to this growth. The company's optimization of product structure and channel structure, improvement in business model, and expansion of production capacity also played a crucial role in driving revenue growth. Additionally, the strengthening of product development capabilities through R&D investments and commercialization of new products contributed to the increase in sales volume from 178 million pieces in 2024 to 185 million pieces in 2025. On the other hand, the primary drivers of revenue decline were mainly due to external factors such as U.S. tariffs' impact on customized lenses and ODM business revenue. The decrease in customized lens segment by 0.6% and ODM business revenue by 2.9% was a significant contributor to the decline in revenue. The net income of the company saw an increase, although the exact percentage is not specified. This growth in net income can be attributed to several factors related to its profitability margins. One key indicator of this improvement is the gross profit margin, which rose from 38.6% to 42%. This significant increase suggests that the company has become more efficient in managing its costs and pricing strategies. As a result, it is likely that the operating profit margin also increased due to the higher gross profit margin. The net profit margin, which is a critical measure of profitability, is expected to have followed suit. Given the rise in both gross and operating profit margins, it can be inferred that the company's overall profitability has improved. This increase in profitability is likely to have contributed to the growth in net income, making it a positive trend for the company. The company's financial performance has shown a significant improvement in recent times. One of the key indicators of this growth is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various activities such as paying off debts, investing in new projects, and distributing dividends. As confirmed by the financial statements on page 24 and page 31, the company's operating cash flow has been consistently positive over the past few periods. This trend suggests that the company is well positioned to meet its short-term obligations and invest in future growth initiatives without having to rely on external funding sources. Overall, the generation of positive operating cash flow is a testament to the company's financial health and stability. The company's financial situation regarding its debt level and interest expenses has undergone significant changes. A notable decrease in total debt from RMB 289,623 to RMB 261,602 indicates a reduction in the company's overall debt burden. Furthermore, interest-bearing bank and other borrowings have also decreased by RMB 28 million. However, despite this decrease in debt, the gearing ratio has improved significantly, decreasing from 18.3% to 9.5%. This suggests that the company is better equipped to manage its debt obligations. On a more concerning note, interest expenses have increased by approximately $25.1 million due to the repayment of bank borrowings. Additionally, unutilized net proceeds have decreased from $47.3 million to $37.2 million, indicating reduced available funds for debt repayment. Overall, while the company's total debt has decreased, its interest expenses have increased, and the availability of funds for debt repayment has also decreased. This suggests that the company is still grappling with managing its debt obligations effectively. Management is optimistic about the company's future prospects, with plans to strengthen its market position through strategic initiatives. The key strategies include expansion into new markets, automation to improve efficiency, and product development to stay ahead in the industry. Furthermore, the company expects a significant boost from its XR business by 2026, indicating a strong focus on emerging technologies. In addition to these domestic efforts, management is also investing heavily in international markets through projects in Thailand and Japan. This expansion is complemented by the establishment of a joint venture for research and development of prescription lenses for smart glasses, underscoring the company's commitment to innovation and growth. Overall, management's outlook suggests a forward-thinking approach, with a focus on driving revenue and profit growth through strategic investments and technological advancements. The company has a history of paying dividends to its shareholders. In fact, it has been confirmed that the company has paid dividends in previous years, page 1, page 15. Specifically, for the years 2024 and 2025, the final dividend per share was RMB 0.16 and RMB 0.2 respectively. Furthermore, the total dividend for 2025 was RMB 0.35 per share. This demonstrates a commitment to returning value to shareholders through regular dividend payments. There are growing concerns about inventory buildup and potential supply chain disruptions. One key indicator of this issue is the significant increase in finished goods inventory, which rose by 4.3% between 2022 and 2024. This accumulation of excess stock can lead to a range of problems, including wasted resources, reduced efficiency, and decreased competitiveness. The root causes of inventory buildup are multifaceted, but they often stem from overproduction or underestimation of demand. When companies produce more goods than they can sell, it results in unnecessary storage costs and potential obsolescence. Furthermore, if manufacturers fail to accurately forecast consumer needs, they may end up with excess stock that cannot be sold. The consequences of inventory buildup can have far-reaching effects on the entire supply chain. Excess inventory can tie up working capital, reduce cash flow, and increase the risk of stockouts or overstocking. Moreover, it can also lead to decreased customer satisfaction due to delayed delivery times or reduced product variety. To mitigate these risks, companies must adopt more agile and responsive supply chain strategies. This may involve implementing just-in-time production, improving demand forecasting, and investing in digital technologies that enable real-time inventory management. By doing so, manufacturers can reduce the likelihood of inventory buildup and ensure a smoother flow of goods through their supply chains. That concludes the financial summary for Shanghai Conant Optical Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.